We're going to pick up where we left off here. We were talking about volatility and really the lack thereof, and what I call the calm before the storm. And you never know when that's going to hit. There's a lot of things that are out there that are positive in the economy. Unemployment is fallen significantly. There's some good things going on, but we're at all-time highs, and I study markets on a technical basis, and we're at really 100-year highs relative to projected points in the market. So it's not a time to be super aggressive by any stretch. It's just the opposite. It's a time to look to make sure you have proper risk management, proper allocation, maybe some alternatives. We'll talk about all those things, but I want to give you some context, some texture to this to help you to understand it, because it's a little elusive. There's a measurement called the volatility index, which is the VIX, and that measures volatility. To give you an example, right now, the VIX is around, it's been below 11 in the 10% range. Now today, it's in the mid 11s. Okay. Let's just call it 11.5 for hypothetical sake. And we're at all-time highs. Okay. So we're at all-time highs. Let's go backwards in time a little bit to help you understand this and where my concern lies. Basically, we're at the most bullishness of investors and money managers since 2007. The VIX is at levels that we've not seen really since around 2007. And so let me give you some real exact numbers to put this again into context. So in May of 2007, the VIX was, guess what? 11.47. And actually, the VIX is around 1150, give or take, really around 1147, 1148. And the S&P 500 at that time in 2007, which we were in a bull market, was at 1440. Okay. Now, unfortunately, I have to have you do a little math here, which I know all of you love. I'm joking. Most of my clients don't like math, but I do have a lot of engineer clients, and of course, they love math even more than I do. But all kidding aside, so the VIX was at 1147 in 2008 in May. The S&P 500 was at 1440. Within 5 months, in October of 2008, the VIX was over 89. Okay, so the lower the VIX, the better for the market. The higher the VIX, so the more volatility, the worse for the market. So in October of 89, the VIX went from 11 in May, 1147 to 89. The S&P 500 fell from 1440 in 5 months to 840, which was minus a negative 41% drop. A 41% drop. I'll say it a third time. A 41% drop. Now, I'm not a prognosticator of markets by any stretch of the imagination. I'm a protector of capital for clients. My clients are at the stage in their life where we're trying to protect capital. I always use the term, we've already kind of won the game. We are either in retirement or near retirement, and we're not trying to eke out every inch of every gain of the S&P or the market. We are trying to make sure that we have lifetime income, that we can protect our capital and make sure that we can maintain quality of life. So my point being here is, we have things that are kind of working against us. The economy has picked up definitely from last quarter. That's a positive. Markets at all-time highs, that's a positive. That's great. We should celebrate that. But the point is that Europe's having some trouble for sure. And there's definitely a spillover effect. They just lowered their interest rates, and they now have negative interest rates for their banks, which means they're trying to get them to lend money. And so that's not a good sign. They're worried about becoming the next Japan, which was in deflation and still is for the last couple of decades. And, we have quantitative easing that has gone away, and we're now in tapering because of the jobs numbers that happened last month or last week. You're looking at a new Fed meeting that's going to happen June 17th and 18th, and they're probably going to reduce the the bond buying program by another 10 million, which will take us from 85 billion to down to 35 billion. We're currently at 45 billion. And I don't see any reason why that's not going to happen. And so, why am I sharing all this with you? That's a question you should be asking yourself, because I care about you and I want you to not get blindsided and not be too aggressive. I'm meeting with clients that are 95% stock right now that are in their 60s and some in their 70s. And it's just nuts. So if God bless you, if you've participated fully in this last bull market and you've made a lot of money. I mean, the market's up 170+% since 2009. But to put it in context, if you include 2008, it's up probably about 50%. So that's what negative years will do to you when you have devastating losses of 40 or 50%. So the question becomes, what do we do about it? And what I suggest is how do we want to protect that capital? How do we want to maintain quality of life? How do we want to capture the gain? And that's a better way to look at it. So if you're up and your account looks great right now, how about what if I showed you a way to kind of sell high, protect your capital, not have losses, and we'll talk about that, and still participate in the market? I mean, that sounds almost too good to be true. I mean, I do it every day. So we can have guarantees that are based upon the claims paying ability of the insurance companies that we pick, but there is some great strategies to where we can actually lock in the gains, still participate in the upside of the S&P and not lose money, and have guaranteed income streams that can last our lifetime. But the good news, we still can make money. And so if you're interested in this type of strategy and you're interested in talking to me about our second opinions that we give, which will review your entire plan or lack thereof. Most of you do not have any type of written retirement distribution plan, financial plan. All of our clients do. Give me a call, 877-406-CALL, 877-406-2255, 877-406-2255. Also, for the first 5 callers, I'm going to give away a white paper that I've written, a report that's actually going to, it's a book that I'm working on, and it's a great piece. Obviously, I'm proud of it. It's mine, and it's called The Ultimate Retirement Blueprint: The 7 Secrets to a Stress-Free Retirement. And part of my job is not only just to help you to protect and make money, but maintain quality of life and reduce your stress. Stress kills. I work with doctors and they will tell me that, stress can take off 30% of your life. We don't want that. I want you to live a healthy, strong life. And that's the most important thing, really. It's not about numbers and money. It's really about people first. So if you want a copy of that report or you want a second opinion from me personally, you can either reach out to me at, again, 877-406-CALL, 877-406-2255, or go to our website. It's actually probably best. That's reyesplan.com, REYESPLAN.com. You also can email me personally with any questions. We do our email of the week, so please email me. I'll be doing the email of the week at the last segment, so please stay tuned for that. And my personal email is david@reyesplan.com. It's david@reyesplan.com. So, meeting with clients every week. Last segment, I was talking about a client that kind of had a little meltdown and how concerned she was about the market, and we talked about some strategies that we can employ to help to mitigate that risk for her. Because most of you out there don't have any type of what I would consider formal risk management, and basically, what's also included in my white paper, my report, in the Ultimate Retirement Blueprint, is some strategies that we talk about on how to protect that. And one is through guarantees, which you can only get through annuities. And anybody with less than probably $3 million of assets needs to have some type of principal protection. There's no question. And I would say 99% of most annuities I don't like. I'm a fiduciary, which means I have to put your interest ahead of the firm's and my own, which we choose to be a fiduciary. So I'm going to give you the best, hopefully most unbiased advice possible. In doing so, there's a handful of really, really good products out there that can protect capital, that can have you participate at a high level in the market. So you can kind of have your cake and eat it. But unless you see it, it's hard to believe. So again, give us a call if you want a copy of my soon-to-be book, but the abridged version, which is the white paper right now, the 7 Secrets of a Stress-Free Retirement, the Ultimate Retirement Blueprint. And I'll give that to the first 5 callers at 877-406-CALL, 877-406-2255. Also, if you'd like to get a complimentary second opinion to look at all of your finances, your taxes, your investments, my partner's a CPA, your estate plan, long-term care, all those types of issues, please feel free to give us a call. Again, 877-406-CALL, 877-406-2255, or please visit our website at reyesplan.com. So we'll be back in a couple of minutes here. I'm going to be talking about some additional strategies here and some other tips I can give you. And then we're also going to get into our email of the week, which I'm excited about. It's a good one. So you're listening to David Reyes, the financial architect on KFMB AM 760.
You're listening to the Retirement Architect, David Reyes.
Common sense or amazing guesswork?
No guesswork here. The Retirement Architect, David Reyes, will continue next.